Most people think the US economy is either headed straight for a recession or a stock market boom, but the truth is much more nuanced, and what it means for your money isn't about guessing which one wins. Hey, this is Zero to Wealth. I break down what big economic numbers really mean for everyday people, not just traders. Today, we're unpacking the latest US and global forecasts to answer a deceptively simple question: recession or rally? And more importantly, what should you do with your money in 2026? A lot of folks are feeling something similar right now. You're watching news headlines that flip between recession fears rising and markets poised for a rally. Your 401k feels unpredictable. You're uncertain about buying a home, keeping cash on the sidelines, or investing more. Maybe you've had conversations like this. Are we heading into a recession for sure? Should I move my investments to cash? When will the economy stabilize? And on the surface, it does look confusing, especially when news outlets give conflicting takes. But here's why it feels so hard to make financial decisions right now. The economy isn't binary. It's not only recession or rally. It's a mix of forces: growth, inflation, labor trends, interest rates, and global cycles, all pushing and pulling at the same time. To make sense of it, we need to step back from headlines and look at data and what economists are actually forecasting. Let's break down the key trends shaping the US economy today and what they imply for potential recession risk or continued growth. 1. Growth. Still positive, but uneven. According to recent forecasts from major institutions, many economists expect the US economy to expand moderately in 2026, not shrink. Goldman Sachs projects US GDP growth around 2.5–2.8% this year, stronger than consensus. A Securities Industry and Financial Markets Association (SIFMA) survey shows economists expect about 2.2% real GDP growth in 2026. These aren't recession figures, they're growth figures. To give context, between 3% and 2% growth is typically considered moderate expansion in a mature economy like the US. 2. Inflation trends, cooling but sticky. Inflation matters because when prices rise too quickly, consumers spend less on other things, the Fed feels pressure to keep interest rates high, and borrowing gets more expensive. Right now, recent forecasts indicate inflation is cooling, but core inflation may stay above the Fed's 2% target for a while. Goldman data suggests core inflation could be around 2.1–2.3% by year-end, especially after tariff effects fade. That's closer to normal than the 5–8% we saw in prior years, but it's not back to the historic 2% Fed target yet. 3. Labor market, stable but not exploding. One of the biggest factors in recession dynamics is employment. Here's what forecasters are saying. The unemployment rate is expected to hover in the mid-4% range, not 7–10% like in historical recessions. Job growth has slowed, but not collapsed. A slowing labor market can signal recession, but a stable one at moderate unemployment usually signals no deep downturn. 4. Recession probability, not zero, but not certain either. Different institutions put recession odds in different ranges. Some surveys suggest recession fears have eased to their lowest in years. J.P. Morgan's research has historically pointed to possible recession chances but still expects resilience. Forecasts vary, and uncertainty remains, especially as policymakers grapple with inflation, trade policy, and global conditions. But a recession isn't the consensus outcome right now. 5. Stock market outlook. Wall Street thinks rally. Wall Street analysts, across a broad set of firms, expect markets to grind higher in 2026. This is driven by earnings growth, potential Fed rate cuts, and corporate profitability. That doesn't mean markets will go straight up or without volatility, it just means the average forecast is not a crash scenario. 6. Global context, growth with uneven risk. Outside the US, the global economy is also forecast to grow around 2.7–2.8% for 2026. Some regions face sharper challenges, but broadly the world is avoiding a synchronized downturn. That international growth can help U.S. corporations earn more abroad, and that supports markets and jobs. Now here's the key insight most people miss. Economic forecasts aren't predicting a binary outcome of recession or rally. They're forecasting a spectrum of slower growth, continued expansion, lower inflation, and moderate risks. This matters because it means the economy can grow without reigniting extreme inflation. Markets can rally even if some sectors slow down. A mild recession, if it happens, might last a short period and be shallow, not a deep 2008-style collapse. The shift from fearing only a recession to understanding range of possible outcomes is the real turning point in how you should think about your money. So, if the economy isn't a simple binary, what should you actually do with your money? Here are practical, calm, investor-friendly steps. 1. Revisit your financial plan. Spend 1 to 2 hours reviewing your budget, emergency fund, savings rate, debt levels. A recession or slower growth impacts cash flows, so make sure you have 3 to 6 months of expenses set aside. 2. Don't react to every headline. Data releases happen weekly, and markets often move faster than the economy. Avoid making knee-jerk decisions. Stick to your long-term plan instead of chasing the latest recession narrative. 3. Diversify across sectors and asset classes. Moderate growth environments tend to reward quality stocks, companies with strong earnings, bonds or cash when yields are attractive, international exposure to capture global growth. Diversification isn't glamorous, but it's effective. 4. Keep an eye on interest rates. If the Fed can cut rates in 2026, something many forecasts are pricing in, that could stimulate growth and support markets. But if inflation remains sticky, rate cuts could be delayed. Keep your financial plan flexible to adapt to either scenario. 5. Treat market volatility as opportunity, not fear. If markets dip, evaluate if prices reflect changes in fundamentals. Only rebalance or buy more if it fits your strategy. Volatility doesn't have to be a threat, it can be a source of long-term returns for disciplined investors. 6. Update retirement and investment contributions. If you're saving for retirement, keep contributions consistent. Compound growth over time beats timing the market. Consistency timing. 7. Educate yourself continuously. Economic conditions evolve. So should your financial knowledge. But always ground decisions in data, not emotion. Let's zoom way out. Historically, recessions are normal, not anomalies. Economies expand more often than they contract. Markets reward long-term patience more than short-term guessing. Most people both overestimate short-term risks and underestimate long-term opportunity. Right now, we're in a phase of moderate growth, lower inflation, and persistent uncertainty, not crisis. That means today's winners will be those who focus on fundamentals, stay diversified, avoid panic. Financial success isn't about predicting exactly when a recession hits. It's about preparing for uncertainty and acting consistently. If you want more thoughtful breakdowns like this, data first, no hype, feel free to subscribe. I'd love to help you make sense of the economy and grow your financial confidence. Thanks for watching, and remember, your financial future isn't determined by headlines, it's shaped by your habits.